This is Brent with Trade Therapy, and today we're breaking down the institutional roadmap behind one of the most carefully engineered setups in the market right now, which is Walmart. Walmart was our clarity spotlight last week. Walmart is not a stock that's in trouble. It's a chart that's under construction, and everything we're seeing in the monthly, weekly, and daily chart really confirms that, and we're going to walk through each one of them, starting with this clean monthly chart right here. Walmart has built this broad and really disciplined reaccumulation range right here, right at the top of this breakout in September. This breakout was not driven by euphoria. It was very controlled. The volume shelf down here at 46 really tells you all you need to know. Wall Street moved in here with size, not with hype, not with headlines. They came in with capital and patience and structure, and the chart reflects that. If we jump over to the weekly chart really sharpens that view. What we're looking at in the weekly is a sharp pullback here. It's a classic wave 4 pullback off of this all-time resistance or supply line here. This wave 4 pullback was met with high volume support, which we would expect to see. Trade Therapy and Clarity subscribers know what this means. They know that after you see an impulsive wave structure completed like this, there's a lot of profits left on the table that Wall Street and institutions need to recognize those gains and need to recognize those profits. And so they do so very quickly, very sharply, and then they reaccumulate their position. And so far, what we've seen since then is this base has held. We don't see any additional breakdowns. We don't see any additional volatility. We see the tape get really quiet. And that's also reflective of institutional control. That's not retail investors coming in and maintaining a price in a range while they accumulate their position. That's institutional strategy. That's institutional discipline. If we jump over to the daily chart, what we see on the daily is a classic flush down below support, below this blue 200-day exponential moving average. We see big gap downs and we see a very sharp angled drop here. These are tactics that Wall Street and institutions use to take out stop losses, to scare retail investors into selling to them at the bottom. And we see elevated volume at the bottom, at the lows. That is classic institutional reaccumulation activity. We see volume surge. We see RSI divergence, which is reflective of the buying going on under the hood, but not really being reflected in price movement. That's what builds divergence. So that's what we see here in the daily chart, because Walmart's not breaking down. This was a trap. This is how Wall Street and institutions take profit and then reaccumulate their position. So as retail investors are asking the question, what's wrong with the consumer sector? Why is Walmart breaking down? That's the wrong question. The right question should be, how did Wall Street build this position and why are they defending it? So what does that mean? If we jump back over to the monthly chart, it tells us all we need to know. They built this position at 46. This takes a lot of effort and a lot of resources to build positions like this. In our Clarity Spotlight, one of the main focal points of last week's article was titled "The Strategy Behind the Obvious." The strategy behind the obvious is reflective of institutional discipline and plans. They didn't extend all of the resources required to hold a stock like Walmart, one of the biggest companies in the world, to hold it flat like this for an extended period of time, years. That takes a lot of resources and a lot of effort. And they didn't do that just to bring price up to 100 and call it a day. They've got much higher targets for Walmart. They've got much higher targets for their plan. And so the strategy behind the obvious, we've already stated, they needed to come up here and recognize these profits, recognize these gains, and reaccumulate their position. And they do that by engineering shakeouts. They do that by engineering these pullbacks and these long wicks under these moving averages, that's how they take out retail investors and rebuild their position. So they create inefficiencies with these overnight gaps and these volatility spikes to generate liquidity so that they can get back into their markup plan and start moving Walmart to higher price targets. We did present some trade considerations moving into this week with Walmart. 105 is really the continuation that we are going to be looking for an entry. For if we are going to go long, we're going to be looking at 105 for a continuation up to these higher Fibonacci levels, 117. Really, 118 is the first target before it goes on to 142. Our stop would be set just below 105, probably below the highs from last week. A breakdown below 87 here, below this 2618 Fibonacci level from the wave 1 high to the wave 2 low. That's what these extensions are based on. If we see a further leg down here that loses all of these moving averages and breaks down under 87, that's our bearish, and we'll be reevaluating our long views from there. This is all part of the cycle where retail really gets distracted by the headlines. That is the plan. That is the strategy. But if you're watching the tape, you know better. This is the quiet period before markup continues, not the aftermath of a breakdown. This is the reaccumulation period that sets up the next leg up. I'm Brent with Trade Therapy, where we decode the structure so that you don't fall for the noise. Make sure you're subscribed. We'll be back next week with another breakdown.